One of the biggest reasons people love investing in income-producing real estate is because of the tax benefits. In particular, depreciation makes it so we can generate positive cash flow that we don't necessarily have to pay tax on. I'm Gabriel Velez, partner at Tehrani Velez, and we're a tax and accounting firm based out of Irvine, California. In this three-part video, I'm going to explain what tax depreciation is, how it fits into your overall investing tax strategy, and describe some differences between residential and non-residential real estate tax treatment. So let's get into it. So what exactly is depreciation? In the context of tax and accounting, it's not the opposite of appreciation, which has to do with the fair market value of an asset. No, depreciation is a cost allocation and recovery system. Rather than writing off a full piece of an asset the day you buy it, you typically have to spread it over several years, the time period which is approximating its useful life. Because of the subjectiveness and uncertainty with trying to figure out an asset's useful life, the IRS created a tax system, or a system for taxpayers to follow, called the Modified Accelerated Cost Recovery System, or MACRS for short. One quick comment on depreciation. An asset must be placed in service in order to qualify for depreciation. That means a property used personally won't qualify, nor will a property you're planning to fix and flip. For real estate, placed in service means you're using the property to generate income in a trade or business, or making it available for rent, so long as your intention is to actually rent the property. Okay, so the next thing I'm going to do is expand on how the MACRS system works. The main areas of concern are 1, the method by which we're depreciating an asset, and 2, the recovery period. The recovery period is the number of years you get to spread your cost over. So the fewer years, the more depreciation you get to take in each year. The method of depreciation is how you allocate that cost over the recovery period. Straight line depreciation, for instance, takes the same amount of depreciation every year, whereas a 200% declining balance method would take more depreciation in early years and less depreciation in later years. I'll give you some concrete examples by running down a few of the more common asset categories. The first thing to know is land does not depreciate. When you buy real estate, you're always going to have to allocate the purchase price between the land and the dwelling. Whatever cost is allocated to the dwelling is what you use for depreciation, and the cost allocated to land just sits there until you dispose of your property. Non-residential real estate, which we'll describe more in detail in part 3, depreciates using the straight line method over 39 years. Residential real estate, which I'll go to in more detail in part 2, depreciates on straight line depreciation. Straight line over 27.5 years. Next, you have land improvements. That includes fences, landscaping that's not on the perimeter, driveways, parking lots, etc. 15-year straight line depreciation. On the slide, you'll also notice this thick gray dotted line. This line separates real property from personal property, sometimes referred to as realty and personalty, respectively. This distinction is important, as we'll see later on. Realty and personalty have a lot of differing tax rules. Personal property depreciates under a 200% declining balance method, and we typically call the asset class by its recovery period. So an example would be 7-year property, which includes office furniture, fixtures, and general equipment. And you have examples of 5-year property, which are like computers, high-speed printers, POS systems. Actually, a lot can be considered 5-year property. What I just described is the general depreciation system under MACRS, GDS. There is also an alternative depreciation system, ADS, but the GDS is used more frequently than ADS, and it's just impossible to go through everything in a short video. I haven't even touched on alternative minimum tax, AMT. In general, you want to be able to deduct your costs as soon as possible to take advantage of the tax benefits. This will increase your short-term cash flow because it's not going out to taxes, and it'll allow you to get more out of your investment. Of course, there are many factors to consider, like if you use debt to finance the purchase of an asset, you have to address that in future periods. You have to, the negative cash flow, either by refinancing or biting the bullet. Also, our current tax laws are extremely favorable, historically speaking. So you might want to lock in your tax rate now rather than wait. But I digress. More deductions now are generally better than waiting. That's why it's good to understand the difference between an asset that you have to depreciate and an expense that you get to take a deduction on day one. An improvement to your property is classified as an asset and falls under MACRS rules for deductions. Items classified as repairs and maintenance are deductible in the year incurred, irrespective of any of the aforementioned rules. Some examples of repairs and maintenance include roofs, as long as it's just the shingles and the soft membrane and not the actual decking. Decking is an improvement. Painting, termite inspection, service, spraying the wood, not new wood, of course. And you also have de minimis rules where something like that might be technically an asset, you get to deduct in the first year as an expense because the cost is negligible. So anything less than $2,500 per invoice or per item that is shown on an invoice is de minimis. In order to qualify for the de minimis rules, you must elect them on the tax return, and you need an accounting policy, written or unwritten, and this typically means that you have book conformity. You may also qualify for a $5,000 de minimis threshold if you have an audited financial statement. Another strategy for accelerating how quickly you can recover your costs is termed cost segregation. Cost segregation is a marketing term for breaking down a property or a set of improvements down into smaller categories in the attempt to take advantage of more advantageous depreciation rates like those applicable to land improvements and personal property. In the world of taxation, residential real estate is any real property whose intended use is as a dwelling by an individual or family. This definition differs from the real estate industry's definition, where residential typically means a dwelling with no more than 4 units, which would exclude apartment buildings. I'm Gabriel Velez, partner at Tehrani Velez, LLP, and we're a tax and accounting firm based out of Irvine, California. In this part 2 of my 3-part video, I'm going to be expanding on the topic of depreciation as it relates to residential real estate. Residential real estate generally having a 27.5-year life under MACRS. Let's do it. The first thing we have to do when we buy a rental property is determine the correct cost allocation. That means breaking down the settlement statement, which used to be called the HUD-1, and the disclosure statement by correctly allocating things like prorated property tax, prorated HOA dues, escrow fees, title charges, and new loan points and fees. Part of these charges are expenses for the year in which they were paid, but most of it actually becomes part of the property's cost basis. Next, we'll allocate the costs between land and dwelling. Keep in mind, land does not depreciate. We can allocate cost using a variety of different reasonable methods, but the most common are taking the county assessor's office appraisal. This typically isn't the most accurate or beneficial, but it is readily available. Or by using a qualified appraisal. Remember, residential real estate depreciates using the straight line method over 27.5. Once your property is up and running, you may from time to time have to furnish it or replace its appliances. For the most part, anything that isn't structural or attached to the property is considered personal property. That includes carpeting, drapes, furniture, and appliances. The great thing about personal property is that it qualifies for Section 179 and bonus depreciation. Both Section 179 and bonus depreciation are forms of accelerated depreciation. How fast is the depreciation, you ask? Well, you get to deduct the entire purchase price in the year that the asset is placed in service. Section 179 is subject to income and investment limitations that I won't go into today, and bonus depreciation has no such limitations, and in a post-2017 Tax Cuts and Jobs Act world has very few limitations altogether. Under current tax law, bonus depreciation will begin to phase out between 2023 and 2026, but that'll have no bearing on assets you put in. Something you need to be aware of if you ever go to sell a property is depreciation recapture. Depreciation recapture works like this. You took depreciation deduction of $100,000. Well, you would have an adjusted basis of $400,000, which is $500K minus $100K. Then you go to sell that property for $750,000, and that would give you a taxable gain of $350,000, $750 minus 400. Of that $350,000, $100,000 would be depreciation recapture and subject to special tax rates depending on the type of property and depreciation you took. The other $250,000 would be treated as capital gains. Capital gains have preferential tax rates. Those tax rates are 0 for taxpayers in the lowest tax bracket, 20% for taxpayers in the highest tax bracket, and 15% for everyone in between. Keep in mind these rates are marginal, and so you might end up with a blended rate. Unrecaptured Section 1250 gain is the term given to depreciation recapture on real estate that is not in excess of straight line depreciation. This type of gain is subject to a flat 25% tax, and depending on your income level, this may or may not be beneficial for you. Recaptured Section 1250 gains are for real estate that had accelerated depreciation. So if you used a declining balance method, or you took advantage of Section 179 or bonus depreciation, you might have some of this, and it will be subject to your ordinary income tax rate. Similarly, Section 1245 gain is for personal property and again is subject to ordinary income tax brackets. One way around depreciation recapture that a lot of real estate investors are familiar with is called the like-kind Section 1031 exchange. I'll talk about this sometime in the future. In the world of taxation, non-residential real estate is any real property whose intended use is anything other than as a dwelling for an individual or family. This definition differs from the real estate industry's definition, where you typically hear the term commercial instead of non-residential, and where commercial real estate includes apartment buildings or anything with more than 4 dwelling units. Non-residential real estate has a few tax rules that are a lot more aggressive than that of residential real estate. I'm Gabriel Velez, partner at Tehrani Velez LLP, and we're a tax and accounting firm based out of Irvine, California. In this part 3 of my 3-part video on real estate depreciation, I'm going to be expanding on the topic of depreciation as it relates to non-residential real estate. Non-residential real estate generally has a 39-year life under MACRS. All right, let's do this. One thing that non-residential real estate has that residential real estate does not is this notion of qualified real property, QRP. Property that qualifies for QRP treatment can elect to take Section 179 depreciation. And it's important to note that currently Section 179 is the only accelerated depreciation available for this type of property, and that QRP has a life of 39 years. That being said, it is expected that Congress will issue a technical correction bringing the life of QRP down to 15 years and opening up the door for bonus depreciation, but we've been waiting for this for 2 years. Qualified real property is any of the following items when placed in service after December 31st, 2017. Qualified improvement property, which I'll define shortly, non-residential roofs, non-residential HVACs, and non-residential fire protection and security alarm systems. This is huge because if you have the ability to allocate the purchase price on a new property to any of these qualifying items, you'll get to recover that cost really quick. Qualified improvement property are any improvements made to the interior of a non-residential property and that are placed in service after the date of purchase. And there is no wait period, so literally you can begin construction on improvements the day after escrow closes and they qualify. Some noteworthy exclusions include enlarging the building, elevators, escalators, and any internal structural framework. The internal structural framework generally means load-bearing walls. In a lot of office buildings, for instance, there are artificial walls set up to create offices or other divisions. These walls are not load-bearing, they're mostly hollow, and as such, they would still qualify as QIP. In wrapping this whole thing up, I'm going to give you a little insight on how we usually look at using depreciation and the other deductions we talked about in our day-to-day, tax planning and preparation. The first rule we'll always look at is the de minimis rule. If we can fit a cost under this rule and in this category, we're going to take it. And because the de minimis threshold is $2,500, most clients are either paying for these items in cash or credit card and want to write them off as soon as possible anyways. Also, because this category is treated as an expense and not an asset, we don't have to bother putting it on the asset list and looking at it year after year. Either bonus depreciation or Section 179 can go next, but typically we'll look at whether a cost qualifies for Section 179 and if the taxpayer will benefit from it. The reason we look at Section 179 next is because the state of California recognizes Section 179, although with lower deduction limits. It does not, however, recognize bonus depreciation. And finally, we'll wrap it up with analyzing the usefulness of bonus depreciation. Any property with an asset life less than or equal to 20 years qualifies for bonus depreciation. This includes land improvements and personal property. Hey everybody, thank you so much for watching our video. If your business is in the greater Orange County or Los Angeles areas and you're looking for a tax and accounting firm that truly understands small to medium-sized businesses, please give our office a call. Otherwise, if you just like our content, please like, share, subscribe, or comment. Thanks again and have a profitable day.